You're now listening to the Taxmart REI podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Taxmart REI podcast. Today, we're going to be discussing taking questions from our Facebook community, Taxmart Investors. If you're not already in the community, you can join by going to Taxmart Investors on Facebook. Just go search for it. We'll come right up. Go ahead, post your question there. We might answer it live on one of these episodes, or we'll get you an answer within the community. Having said that, we're going to be diving into all these questions in just 1 minute. Are you ready for the 2025 tax changes under the new administration? With new leadership in Washington, the tax landscape is shifting fast. These are some of the biggest updates we've seen in years, and if you're not proactive, you could be leaving thousands on the table. But don't stress, we've got exactly what you need. Access our exclusive 2025 tax changes resource, an in-depth tracker that breaks down what's new, what's changing, and the strategies that you need to stay ahead. This isn't just some generic checklist. It's a powerful and live resource tailored for real estate investors like you. Head on over to www.therealestatecpa.com/2025 tax changes to access this essential resource. You'll get immediate insights into how to navigate the new administration's tax policies and how to keep more of your money in your pocket. That's www.therealestatecpa.com/2025 tax changes, because smart investors don't just make money, they know how to keep it. We'll see you over there, but right now we'll jump right into today's episode. All right, and we're back. So what we're going to be doing is, once a month, we're going to be dropping a 5th episode to the show. And can you believe it or not, we're going to be adding another episode, and it's going to be focused on questions from our Taxmart Investors community. We may also take questions that we get via email or other places, YouTube comments, things like that going forward. So really, this is just what our investors asking currently. That's what the purpose of this episode is. So without further ado here, let's go ahead and just take the first question, okay? If I sell a property in January 2025 and I realize a $300,000 capital gain, I'm estimating I'll owe roughly $45,000 in capital gains taxes. Do I immediately owe that tax, or do I file it in April 2026?
Yeah, so first couple comments, whoever that was, so 45,000 divided by 300,000 gain, yeah, they're doing a 15% capital gain. We're going to assume long-term. If that's true and you're in kind of that, right, long-term capital gain, you got 0%, 15, and 20. 20% is really going to be for those, I think it's like 700,000, right? Don't quote me on that. You can go Google it, or Tom, you can Google it. But yeah, we can assume 15%. Great. Assuming you've held it for more than a year. When is it due, right? Bottom line, yes, your answer is correct. It's April. It's not due then and there. It is just due when you file your tax return. Now, with that being said, just kind of wanted to directly answer that. With that being said, you are going to want to think through, should you pay an estimate if there has been no withholding on that sale, which is usually not going to be, right? So you might just want to consider, should I make that $45,000 payment, end of the year, before I file my taxes, something? That is going to be a consideration. We would definitely recommend that. Just to kind of make sure you reduce any sort of issues with penalties, interest, because you've got a huge tax bill due. So we do recommend making a payment sometime earlier in the year before you file.
Perfect. The next question we have, this is a good one. How do we use a partial asset disposition? I removed a roof on my property, got it replaced. And now my question is, how do I know the value of the original roof for the purpose of a partial asset disposition? So just quick, overview of a partial asset disposition for everybody who may not be aware of what that is. So when you buy a property, you're going to depreciate that property, if it's residential, for example, over 27 and a half years. And all of the components of the property start depreciating. Now, that roof, right? The roof is a component that's depreciated over 27 and a half years. Now, say you replace that roof. When you replace that roof, you're adding that new roof to your depreciation schedule, and then you're going to depreciate that roof over 27 and a half years, okay? But what happens to the old roof? Well, the old roof is still on your depreciation schedule in many cases, so now you're depreciating 2 roofs over 27 and a half years. What the partial asset disposition allows you to do is deduct the remaining cost of the original roof in the year that you replaced it. Say the remaining value of your old roof was $20,000. I'm just making this up here, right? Well, instead of having to depreciate that $20,000 over the rest of the life of the property of the 27 and a half years, you just immediately deduct it in that year. All right, so that's more beneficial for you because you're getting a big deduction in that year. So to answer the question though, how do you find out the value of that roof? The primary way of doing it, the most common way, is by having a cost segregation study performed on the property. And they're going to give you the breakdown of the value of all the components within that property, so that maybe if you have future replacements and you need to do future partial asset dispositions, you already have those values. Obviously, we know the primary reason for a cost seg is to break down components for bonus depreciation. But partial assets dispositions is another way. So that's the first way to find out the value of the roof, is by a cost segregation study. The second way is by using the producer's price index and basically indexing back the value of the roof. It's a little bit more complex. We're not going to go into all the details of how that works here on today's show, but that is another way to do it, with, again, cost seg being the most common and probably preferred way to do it. Okay, next question. Income generated by flipping a property would be active even if you're not a real estate pro and have a full-time W-2 job, correct?
Correct. That's the short answer. Yeah, we're not talking about rental property. And is it active versus passive? Yeah, by default, flipping isn't necessarily passive like rental properties are. So yeah, I'm going to assume that you don't just invest some capital into an already, ongoing flipping business. It is going to be non-passive. I know they use the word active. There is technically a difference there. I'll just comment on between active and non-passive. But yes, that would be non-passive.
All right, here's another good one. It's about the real estate professional status. Can you please clarify, if qualifying for the real estate professional status by meeting all the tests and I materially participate, would you still have the 150K loss limitations or not? Short answer to that question is no. When you qualify for real estate professional status, you are not subject to the $150,000 limit, which is also known as the special loss allowance. So for everybody who may not know what the special loss allowance is, if you make less than $100,000, so it's modified adjusted gross income or MAGI, then you can get a deduction up to $25,000 in your rental losses, right? So you can just take those are non-passive. This deduction is phased out $1 for every $2 of income above $100,000 until you hit $150,000, where it's completely phased out, okay? This has never been indexed for inflation. We talked about that in a prior episode. It'd be significantly higher and more favorable if it had been. In fact, many people would not need the real estate professional status, but it has never been indexed. So this is what the real estate professional status, this is where it comes in handy, right? The real estate professional status makes your rental losses non-passive, and it gets you around this. So the special loss allowance is no longer applicable. You could take losses even if you're making more than $150,000. Okay, that is the benefit of the real estate professional status. Next question: do I have to do a cost seg study during my first year of ownership?
The short answer is no. There's a form 3115, 3115, that you can use if you, for example, placed a property in service in 2023, but you would like to do a cost segregation study on your 2024 tax return, for example, right? So different year when you place it in service compared to the year that you want to take the cost segregation study. So you use that form because basically what you're telling the IRS is that you started doing depreciation in 2023 in my example, a specific way. Here's how I calculated it in that first year. But hey, IRS, I got some new calculation and method for how I'm calculating my depreciation on this property. And therefore, I'm including this form along with some attachments and some kind of explanation of how you're coming to that using form 3115 to kind of show how you're coming to that. And then that, yes, will be an expense, any sort of acceleration you can get for that rents property. But bottom line is, no, you don't have to do it in the same year. You would just use form 3115.
Absolutely. There was actually a follow-up question to that one. Is how many times can you use a cost segregation study on the same property? The answer to the question is you could theoretically do a cost segregation study as many times as you wanted to on one property. However, it wouldn't be very beneficial to you. Most of the time you're doing a cost segregation study, usually around the time you buy a property, usually, okay, or it could be in subsequent years if you didn't, but you're doing it one time to break down those components so that you could depreciate them faster, right? Once you do that, there's usually limited benefit to doing another cost segregation study, right? There's not many cases. To answer your question, you would typically only do one.
And just to highlight that too, because I think the people thinking through, do I do it multiple times, might be thinking, hey, I've done some improvements to the property that I need to capitalize. Okay, fine. Yeah. Go do an improvement study. Hey, I spent 50 grand on renovations. Okay, how much of that is 27.5 versus 15 versus 5? Great. Go do like a study on that. But you're not going to do, if you bought a property for 500 grand, that's what your purchase price was. You're not going to do a cost seg every single year on that save 500 grand cost that you have. It's just going to be basically like one and done for everyone. So
next question, when is, and this is going to be a good one, when is 100% bonus depreciation coming back? All right. We're actually going to have Nathan Sosa, National Tax Manager here at our firm, join us in the coming weeks to give us a full debrief of what's currently going on in the world of 2025 tax changes. So stay tuned for that episode. We'll have more information. But right now, the answer is we expect it to be in 2025 at some point this year. But there's relatively little information on specifics in terms of timing, Will it be 100%? Will it be something else? But here's what we do know, and we've covered this before, but here's what we do know so far. We know that there's bipartisan support for 100% bonus depreciation. In 2024, the House did pass a bill that included extending 100% bonus depreciation as well as bringing it back to 2024, right? We're not going to probably see that happen retroactively to 2024 at this point, but between the bipartisan support for 100% bonus depreciation and the current administration's support for 100% bonus depreciation, it is believed to come back at some point during the reconciliation process, which will either take place over one or two bills. Right initially, with the first initial reports of this was that they wanted to get it done within the first 100 days as part as one reconciliation bill would include the tax changes. That has evolved into a conversation of there might need to be two reconciliation bills due to the amount of things that they're adding into these bills, and the taxes would come in the second reconciliation bill at some point later on this year. That's kind of where we're at right now. We'll have to wait and see. Again, Nathan Sosa might have more information for us in a few weeks. You'll have to wait and see. But that's kind of what we know as of today. Again, we're all rooting for 100% bonus depreciation to come back. And I do expect it to come back. But we'll just, again, it's not over until there's a bill signed into law and we're sitting here celebrating 100% bonus depreciation. So to answer your question, maybe in 2025, we'll have to wait and see. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. Here's another good one. Do I need the real estate professional status to use the short-term rental loophole? Okay. You want to take that one?
Yeah, I would love to take that one.
Go for it.
Anytime the phrases real estate professional status and the short-term rental loophole are in the same sentence, usually I know that there's some confusion of kind of what's going on there. So the first thing I'll comment on, think of, I don't know, we're accountants, so we think kind of, T bars or T accounts, whatever. Debits, credits, maybe that's a better phrase. You've got basically long-term rentals on one side, and you've got short-term rentals on the other side. Okay. As you think about long-term rentals, you are thinking, I want to claim real estate professional status. As you think about short-term rental properties you own, you are thinking, I want to claim the short-term rental loophole. Is there a overlap here of real estate professional status can help me meet or help me use short-term rentals over here in this section to make them non-passive? No. So basically, real estate professional status is just for long-term rentals. Short-term rental strategy is just for short-term rentals. It's kind of in the name, but for some reason, there's kind of this mix between the two. But bottom line is that it comes down to the short-term rental loophole exception. Basically is saying, hey, if you have an average stay per guest of less than 7 days on average, that is basically not a rental. So that's basically outside of the whole real estate professional status is turning rental properties into making them non-passive, right? That kind of basically takes them out if you've got that average stay less than 7. So it's no longer under reps, and now it's under its own completely different thing. Add any comments there, Tom, as far as like, do you need that?
I don't think so. I mean, the only thing I could add is that, you don't need it, right? Like Ryan said. And one of the benefits of using the short-term rental strategy, loophole, whatever, is that you don't need reps. And that's why it's so popular these days. And as we had John Bianchi on, a few episodes back discussing, how to actually profitably invest in short-term rentals. Like, again, it's a business. I'm going to have to disclaim this here. It's a business. It's an operation. It's something you have to have ongoing attention to do effectively. But that's one of the benefits of the short-term rental strategy. So we're going to take a few more questions here today. Again, if you guys have questions, if you're listening to this, you're tuning in right now, go ahead and join the Facebook group at Taxmart Investors. It's just go search Facebook Taxmart Investors. You'll be able to see it. Or you can just go to facebook.com/group/Taxmart Investors. And you could go ahead and drop your questions in there, and either somebody's going to answer in the community, or we're going to go ahead and we'll eventually answer in maybe the next episode. So here's a good one. I'm closing on my first short-term rental early this year, and we'll need to put some work into it before it can be rented. Will the cost of paint and other minor repairs be a business expense, maybe a startup expense, or qualifying the de minimis safe harbor prior to the property being placed in service?
Yeah. So in general, if anything's before it's placed in service, we generally think it's going to be capitalized. That's like the broad brush stroke comment to say. So paint specifically, because it's that physical property, generally it is going to be capitalized, and we're generally not going to be using the de minimis safe harbor. But do keep in mind for paint specifically, we're also considering the routine maintenance safe harbor. Sometimes you expect to do that 2 times in a 10-year period. But again, in general, we're going to capitalize it because I'm assuming it's before the property is placed in service. So with that, a brief strategy would be to consider if the paint for right now is good enough, could you have a few stays and then maybe in the off season, get it repainted? Great. That is something that some people do. And now we can for sure start to evaluate things like the de minimis safe harbor or the routine maintenance safe harbor specifically for paint. Now, I just want to mention one last thing. What we commonly say is, again, costs before it's placed in service are going to be capitalized. The only potential nuance there is if you have something that's called consumables. Okay, so consumables would be like toilet paper, paper towels, soap, sponges, things like that, where it's like kind of a one-time use, that those could, yes, be expensed even before it's placed in service. Okay, just kind of keep those nuances in mind because it's not something that's going to stick around. Really, it's literally just a one-time use and throw it away. So that would be like one good example of like what could be expensed before it's placed in service, consumables. But yeah, in general, the short answer again, just to recap, yeah, generally not, and we're going to be capitalizing that.
Awesome.
I'll take one, Tom, that I see here. So basically this one says, my husband received $1.25 million for W-2 income, W-2 job. They did a cost segregation study for $688,000 of depreciation for that first year. Does this mean that they only pay the $562 of income in 2024?
Yeah, that's a great question. So this kind of just, we always get this question too on depreciation. So depreciation is an expense, and this includes bonus depreciation, is an expense on your profit and loss statement. So you're going to have rental income, okay? You're going to have all your other expenses it takes to operate your property, property management fees, repairs, maintenance, all that good stuff. Then you're going to have depreciation. That depreciation is likely going to cause a loss. So if we just assume for the sake of just keeping things really simple, that depreciation was your only expense, then that loss that's created by that depreciation will offset your W-2 income, reducing the amount that you're going to pay taxes on. Now, there's something important to note here with depreciation expense or losses that are rather losses as a result of depreciation that are that high, right? The number was like 500 and something thousand, Ryan, you mentioned?
688.
688,000. That's tremendous. Must have been a pretty big property. There's something called the excess business loss limitations, okay? And the excess business loss limitations allow you, and so we're going to look at 2025 for these, okay? Allow you to deduct up to $626,000 of losses against non-business income for the year, right? Once you get above 626,000, the rest gets carried forward as a net operating loss. So in this case, you'd be limited to 626,000. That's the most that's going to be able to offset your W-2 income. But it's still very significant. If you're at the 37% tax bracket, I mean, which it sounds like you're going to be in for the most part, that $626,000 at the federal level is going to save you $231,620. That's a lot of money. It's a lot, right?
Yep.
So that's still significant. So it may not offset all of it, but it looks like it's going to offset a significant portion of that loss. You're going to be able to use a significant portion of it.
Yep. And Tom is also assuming that you made something like real estate professional status or the short-term rental strategy. That wasn't explicitly mentioned in the comment, but we're assuming that that loss is non-passive by some means, right? Because you've got the W-2. And just a comment too, Tom was assuming married filing joint. The question said my husband. So again, we're kind of assuming married filing joint couple there.
Yeah, those are good clarifications.
Yeah. But absolutely, and it does carry forward, like we said, any excess above, so that 626 for 2025 compared to the 688, that difference there of about 60 grand or so carries forward as an NOL into 2026. So you don't lose it, you just don't get it right now in this year. A little bit of a bummer, but you don't lose it forever.
Yeah, no, it's still super powerful. I mean, if you're able to save $230,000 or in excess of that, that's powerful. And again, this is one of the many reasons to invest in real estate is the ability to offset non-passive income. And we've talked about here on the show, just one thing I wanted to say is that this is not the only reason. Okay. While this is powerful and motivating tool, there are just investing in rental real estate. Because think about this taxpayer also did not pay any tax on the rental income that they generated too, which is also powerful. So there's a lot of things related to that. Maybe we'll cover that again in another episode. But that's going to be all the questions for today. If you do have questions, again, join the Facebook group, drop them in there. We'll either be answering in the Facebook group or perhaps maybe it'll be in the next episode here where we do a Q&A. Last thing before we go, we are accepting clients. If you are looking for a new CPA firm to help you strategize on how you can actually reduce your taxes, not just file your tax returns, of course, we could help you with that too. But if you're looking for someone to help you strategize, we're here to help. We'd love to learn more about your situation and how we can help. We're still in the early innings here in 2025. It's the perfect time to get started. You can go ahead and request an initial consultation by visiting www.therealestatecpa.com/podcast. That's it for today's episode. We'll catch you in the next episode of the Taxmart REI podcast.